But Mazi's been around for a very, very long time, for 16 plus years, managing an excess of 40 billion with a well-established team of investment professionals, total team of 45, with 10 specifically looking at global equity. So a well-experienced team. They've come a long way, really good track record as well. So we're excited to be launching a feeder fund for you, Andreas, and thank you so much for joining us this afternoon. And how are you?
Eugene, thank you for the glowing introduction, and also to Tanya and Robert, thank you very much for the opportunity to present at your global webinar. And we're also very honored to present to your valued DFMs and IFA partners. We feel particularly privileged to be included in a lineup with global equity managers that we greatly respect. Today, we're going to talk about our philosophy, our process, our performance, and also touch on some risk management. We believe that our investment philosophy and process has to stand at the center of everything we do and deliver a result that is consistently excellent, synonymous with quality and performance, and above all, our process has to be repeatable. We believe the foundation of our approach to investment is best said by Sir Isaac Newton when he said, "If I've seen further than others, it's by standing on the shoulders of giants." We acknowledge our quality-focused investment process is built on the work of a great many giants. Taking on board the teachings and practice and temperament of some of the greatest investment minds will make us successful. And we fully recognize that in the work we do, we stand on the shoulders of giants, and we remain in search of tomorrow's giants. Warren Buffett is one such giant. Once a value investor, his days of cigar butt investment are long gone. It was Charlie Munger that put the good sense into his head. It's better to own a great business at a fair price than a fair business at a great price. Today, Buffett is probably the ultimate quality investor, a giant in our own time. If we express our investment philosophy in a single quote, it will be, we seek to buy shares in a great business for less than the business is intrinsically worth, with managers of the highest integrity and ability, and then own those shares forever. What does this practically mean? Firstly, we look for businesses that are run by highly experienced, disciplined, and honest people. Avoiding corporate frauds is at least half of our job. Secondly, we want companies that think long-term in all aspects of their business. Long-term focused businesses survive tough times and thrive in good times. Next, we look for a management that makes rational capital allocation decisions. In other words, economically sensible decisions. Decisions that balance the customers, the company, and the shareholder needs. Decisions that produce sustained profits over time, well in excess of the cost of capital required to make that profit. Furthermore, we want high barriers to entry and exceptionally strong competitive positions. Moats, as Buffett calls it. These barriers can be brands, large installed bases, valuable distribution networks, and hard to replicate intellectual property, to name a few. And they need to widen with each market cycle and demonstrate ongoing resilience to the macro events that come. Equally important, our businesses need to grow at a decent clip. There has to be long-term organic growth at high returns on invested capital. It is this growth opportunity that makes our businesses much bigger and more valuable with the passage of time. When you put all of this together, it usually shows up in the numbers. If the numbers don't add up, don't do it. Profit margins are stable, structurally wide, and resilient to inflation, producing over time a growing stream of excess cash for shareholders. Returns on invested capital are high and remain high, well in excess of the cost of that capital. That is, the company generates economic value for its shareholders. Cash earnings and shareholder funds compound with time. Ultimately, we want businesses that are good for shareholders and do not reward management or customers or suppliers or the government at the expense of the shareholder. Lastly, the crucial ingredient in our investment process is patience. When you find an exceptional business, buy it at an attractive price and settle in for the ride. We are long-term investors. Our portfolio turnover is less than 10% per year. If we reduce our pros to one number, just one idea, what would it be? Return on invested capital. It's the one number that sums the total of all capital allocation decisions in the business of a life, in the life of a business. It provides a view into the heart and soul of the functioning and capital productiveness of the business. Look at global markets through the lens of return of invested capital, and we can see the following. Since 95, the median company has earned a return on invested capital of about 8.7%. This is what the company makes on its capital. This is the green line in the graph. The weighted average cost of that capital has been about 7.6%. This is the red line. This is what the capital costs. In good years, there's been a positive gap, the gray bars. The median company has produced economic value add. In bad years, the benchmark company has destroyed shareholder value. If you plot a cumulative figure for the spread, the purple line, then the median company has only delivered 1.1% over the cost of its capital. This is hardly something to write home about, given all the risk you take. So, what do we want? We want businesses that are substantially better than the average. This is the return on invested capital graph, but for Dekkers Outdoor. Altogether a different story. This is a business we own and bought at the right price. Dekkers is a global footwear brands company. You're unlikely to have heard of Dekkers, but you're probably familiar with Hoka running shoes and UGG boots. The business is highly profitable and growing quickly at about 20% per year. Return on invested capital exceeds 30% with a cost of capital of about 10%. This is an excess cash producing machine. Plenty of growth opportunity and runway here. But let's compare. Nike is the darling of the investment industry. You'll see Nike in many portfolios, but not Dekkers. Dekkers, however, is growing much faster with better margins and is intrinsically more profitable. Yet, Dekkers sells only 30 million pairs of shoes a year, and Nike sells more than 700 million pairs of shoes. On a market cap basis, Dekkers is about a tenth of Nike's size. Trees don't grow to the sky, and on valuation grounds, Dekkers is way more attractive. In our hands, Dekkers has already doubled. From here on, Dekkers is more likely than Nike to double again in price. Running shoes are but one thing. This is the Mazi Global Equity Portfolio. This is what you get if you invest with us. You'll know Google, Visa, MasterCard, Microsoft, Schindler, probably a couple more. But there might be a bunch of companies you don't recognize. These businesses are even more impressive and operate completely out of the limelight. Amadeus, ASML, Cadence, Fastenal, Pro Medicus, Zoetis, all exceptional high-quality businesses with years of profitable growth to come. Run your ruler through our businesses and you'll find rational capital allocation, sane management, structural profitability, moats, and above all, the opportunity for reinvestment in future growth. All up, with patience and despite the macro that may come, these businesses will be multiples of their size. Giants in time to come. The table on the left shows our top 10 return contributors for the one-year period ended 30 June. On the right, we show the top 10 for global equities. Ticks and crosses denote whether we own the stock or not. You've heard the throwaway comment. Tell me your performance and I'll show you your portfolio. Our portfolio does not require any particular theme or market positioning to perform. We did not need to be right on this year's news, ChatGPT, NVIDIA AI chips, or you got to be in Apple because it's the biggest business in the benchmark, or last year's story on oil and gas, or the recovery of mega banks. Only 2 of our top 10 contributors are tech. Arista and Cadence aren't even household names. Microsoft, Facebook, and Google, top 10 performers in the index, do not even make it into our top 10. Our performance truly comes from a diversity of quality businesses, irrespective of sector, ranging from footwear and apparel to luxury goods to cosmetic retail to auto repair, auto insurance value chain, and even something as futuristic as robotic surgery. Let me leave you with one message. An investment strategy built on a quality-focused, profitable, growth-oriented portfolio held for the long term, delivers a consistent above benchmark performance that emanates from a diversity of successful businesses, not the market flavor of the month. Our investors have been rewarded. We launched the Mazi Prime Global Equity Fund a bit more than 2 years ago during the lofty market heights of COVID euphoria at peak market valuations. On the left, we present our performance in Rand. On the right, we show the dollar numbers. Our fund is entirely invested offshore. Dollars paint the real picture of what's going on. Over 1 year, we're well ahead of benchmark. 18 months, we're on track. Over 2 years, there's a bit of catch-up work to do. Where do we stand today? We expect our good performance to continue in all likelihood and to make up the lost ground over the 2 years and since inception. Why do we say this? Valuation multiples for both the market and our portfolio have substantially stepped down from the COVID high. US long rates have repriced from 90 basis points to 420 basis points. And based on consensus numbers, the growth outlook for our portfolio of profitable companies over the next 2 years is almost double that of the market. Quality investment strategy delivers over time. One last slide on risk management. We define risk as the permanent loss of capital. A portfolio of quality businesses, by virtue of the intrinsic nature of the companies we invested in, protects you, the investor, on the downside. Moreover, these companies tend to surprise more often than not on the upside. When times are tough, something all businesses go through, quality businesses take market share. The weak get weaker and the strong get stronger. We strive to own the strong get stronger businesses. All told, a portfolio of quality businesses delivers higher returns over time at lower levels of risk. The numbers speak for themselves. Thank you. Please feel free to get in touch with us for a coffee. Please take a look at our website and our LinkedIn profiles for more details. Eugene, over to you if there are any questions.
Yeah, thank you very much for that. We're very much out of time, but I've got a very, very quick question for you. In 30 seconds, to partly understand your screening process and how it works behind the scenes, why would you not invest in a company like NVIDIA?
The valuation is completely out of kilter for us.
The valuations on which matrix?
So we have developed quite a sophisticated set of valuation tools, and essentially when you look at NVIDIA, it is not a prodigious producer of free cash. In fact, it raised cash at the recently. It raised about $10 billion. And so fundamental for us in terms of our quality focused investment process is, A, does it produce a lot of free cash, evidenced by a very, very wide spread between what it earns on its capital and what it pays for its capital. And then secondly, the growth that is there, and then what are you paying for that growth? And if you understand that relationship well, then by our criteria and our standards, we will not invest in NVIDIA. We don't see a return for our shareholders from these levels on.